My name is Jessie. My background is heavily in tax, but not to tell you my age, but I've worked with a lot of old school partners who believe if you're going to be a tax professional, you need to know the books as well. So I've always been pretty well rounded. And in grad school, I knew I wanted to do business, wasn't sure. I wanted to do tax, wasn't sure if I wanted to do accounting. So I did a lot of free work for some of my professors, and most of them was bookkeeping. And then I took my first tax course, loved it. I volunteered every Saturday, and it was early, which means no partying Friday. Get up Saturday, and I actually loved it. It didn't feel like a sacrifice. I loved it, and that's when I knew tax was it. So I've worked in public accounting for a little under 10 years. But total since grad school has been a little over 10. And I just love what I do. I love spreadsheets. I think they're very sexy. I started doing my own thing about 2 years ago, officially. I've done taxes for hedge funds and private equity funds, and I did small businesses as well when I went to a smaller firm. And just a lot of mom and pops, and I do like working. What I do like about my job is the teaching aspect of it, and I've been bitten by the bug. I've adjunct professor for a while, and I just really like it. I do a lot of career days at schools for the younger kids, and it's very hard to explain what an accountant is. So I just have to tell them I count money for people like Chris Brown, and they get really excited. So that's my background. You'll see here my fancy letters. I'm a CPA. I did my MBA as well. So what helps with the MBA is that it puts me in a consulting role too, and with my tax and accounting background, it kind of helps me business owners, and I'm a small business as well, so I pretty much get the whole gist of everything. So I'm just gonna dive in. So we're gonna start at the basics. So you decided you have a business, or you have this great idea, you're talented, you want to sell products, whatever the case is, you want to start your own business. There's a number of things you want to start doing. Figure out how you want to structure. And if nothing, you want to get that EIN. Now someone say, hey, I've been doing this from my home, I'm just selling here and there, I've really been operating without an EIN. Do I really need it? The answer is not really. If you're a sole proprietorship, we all know what that is. Everything just flows through you. You don't organize anything. You don't need an EIN. But I say get it because it's free, and you never know. Opportunity might present itself. You might or should be getting a bank account, and a bank won't give you a business account unless you have an EIN. Let's say stuff picks up and you need to hire someone. You should be getting. If you have employees, you don't want to use your social security number, you can use your EIN. If someone hires you now and they have to give you a 1099, you don't want to give them your social, you don't want your social security number or anything. So people ask me all the time, record keeping, what should I keep? Definitely do not keep a shoebox of receipts. There are plenty of apps out there that can help you organize. If I see a box of receipts, I'm going to die. I'm not even going to touch it. So I say keep everything. Everything you have, just keep it. Now, you don't need to hand over a box of receipts. You don't need to hire someone to put it together. You definitely don't need it to do your tax return. I pretty much would, if you say to me, these are the numbers, whatever, I'm going to ask my due diligence questions, but I'm never going to ask you for a receipt. I don't. So, but in the event that you get audited, you want to be able to back your claim. So that's why I say is save this. You have a Google account, get your Google Drive, save it in there. You have an app. If you're self-employed, there is the QuickBooks Self-Employed Edition. It's like no more than $10. If you get it through me, it's $5. It'll always be cheaper if you get it through an accountant. Any invoices, like you said, sales receipts, canceled checks, deposit slips, but we're so technical savvy. Sometimes if you swipe your card to go to dinner, I personally won't keep that. It shows up on your bank statements. I tend to save my bank statements because some banks don't go as far back as others. Like I know Chase will only go back maybe of last year, not even entire year 2017. So it's good to always download that from your bank and just save it on your Google Drive. So at least you have actual documents of, that dinner that you paid for that was business, something to document it. And in the event of a random audit, they like to see that stuff, that you have good records, that you've been keeping stuff. That alone says a lot about you. So just save it and keep it somewhere organized.
Sure. For how long should you keep these things?
I'm going to go into that in the next slide. So the question is how long, right? How in debt? I say as long as you can, because it's like, you get your Google Drive. Are you going to be, scrapped for space? It's highly unlikely. You just get another account. But in terms of, I like to keep a rule, like it says here for tax returns. There's an expiration date on a tax return. It's 3 years. 3 years from the date that is due. So I would keep anything pertaining to that fiscal year for a minimum of 3 years. I would keep it for 3 years. There's other things, there's other rulings. For instance, there's, I know employment, if you're doing payroll, I think they do 4 years. So you want to keep it for 4 years. Obviously, if you own a building or property, that title bill, you want to keep that for as long as you have the property, because you don't know when you're going to sell it. So as long as it is material, like obviously, you're not going to keep a receipt that you went to a restaurant. I'm not going to keep this receipt that, the company paid for forever. It is what it is. It's in my bank records and that's it. But in anything substantial, like, I don't know, maybe you bought a whole bunch of computers for everyone, you might want to keep that, because then the depreciation comes into play, whereas you get challenged with that. These are things you just want to kind of keep around. Documented stuff as well, is really good. So I say 3 years, but I personally would keep it forever, Okay, so bookkeeping systems. Now, I am a big fan of QuickBooks. I'm a big fan of, I like Xero, but anything that helps you to keep your records. So I'm just going to teach you the basics. And I'm going to have a bonus debits and credits class too if people are really interested. Really? Oh my God. All right, I'm a little excited.
Doesn't take much to really get the spreadsheet.
Yeah, so there's two, I'm going to go back to old school, let's get a little history. So there's two ways in which you could keep your record. If you're doing it yourself and you say, you know what, I don't care about debits and credits, I just want to keep something so that I can give to my accountant. I'm not making $10 million in revenues. I don't have any assets of that amount. I just want to show you my cash in, cash out, and that's it. So you want to use something that's a simple entry system as compared to a double entry system. We'll get into that. But simple is the simplest, it's easy. You know what comes in and out. You could pretty much, if you didn't do it every day, you're doing it on a monthly basis, you have your bank statement, you could upload it into an Excel file, and boom, you pretty much have it. You go through it to see if it makes sense. Does it tie with your bank and bank statement and all that stuff? And most of the times it will if you're doing a one-line stuff. There's no balance sheet involved in that, and that is okay, and I'll tell you why in a second. And it's not a complete way of doing your books. It's not what the GAAP rules say, of doing it, but it's sufficient enough to do a tax return. And if you just don't have the capacity, you just don't want to be bothered, I totally recommend this. The right way to do it is your double entry, which is a little bit more complex. It has a built-in check or balance, and it does do a balance sheet. And it just, it has like a twofold thing. So if you have a transaction, you purchase this piece of paper, two things are happening. Sometimes it might be three. So you purchase cash is in there, and then you have supplies. Supplies, your inventory supply goes up. If you pay for a credit card, and you have accounts payable, whatever. So there's always like two things. But if it's a single entry, all it is that you just had an expense, and that's it. You had an expense, and you just write it down. Paid for office supplies, and that's pretty much that. Now, the reason, and this goes with your cash and accrual system. So your cash method would be used mainly for your single entry. So what would happen is that you receive cash and you record cash or entry whenever cash after received, and when you actually pay for something, that's when you record it. You don't record anything until the cash moves. So until you receive money and paid for something, you don't record it. And that's pretty much what the cash method is, and it ties very closely to your single entry system. If you're going to use the accrued method, and this is what I'm going to do a bonus on sometime before the year ends, the accrual is what really is more favorable. That's when you, for instance, if I send Pete a bill, obviously, let's say I did the work, I decided to bill him. The second I create that bill and send it to him, I have to increase my revenues. I haven't got the cash yet, but he now owes me and my revenues went up. So I create an accounts receivable, because I'm expecting him to pay, and then I have revenue that went up. Now, what happens when he pays me a month later? So a month later, my revenue stays the same, but now my cash went up, and that accounts receivable goes down because he already paid that bill. So that's the twofold, that's the double entry, and that's what I'll probably go into more. The last two lines here, if you're on a 10 million in assets, but average, you don't need to do a balance sheet. If you ever look on a business tax return, if this person is just bringing in, 100K, they might just leave that balance sheet blank because it's not required for the IRS. So that's why if you want to do it on your own, the simple way to doing it is better. If that's where you want to go, I recommend it. But if you say, hey, I want to keep my balance sheet, you never know, I might hit 1 million, 10 million, God knows when, and I just want to be ready. By all means, the accrual is there, and you could option to present the balance sheet to the IRS. Now, there's certain industries where you need to, like in this example, inventory. Inventory is a little bit special, it's more complex, so whether or not you're making 10 million or more, you should be reported on an accrual basis. And that's that. Any questions? Okay, let's do the test. So I'll read this to you. So Sandy has a warehouse where he sells a custom order and handmade knitted goods, hats, scarves, and socks. Customers order online, but because it could take a few weeks or even a few months to get the supplies and finish the order, he doesn't charge them until the product actually is shipped. Sandy uses the accrual method for accounting. He records the sale in a month when the product is shipped, not in a month when the person orders it. Is he right in his method? Is he wrong?
No, he's using the cash method.
He's using you're saying he should be using the cash? Because he's using the accrual right now, as it says.
He's using accrual?
Yeah.
So then it would count when the order was placed.
Yeah, so it says
Not
here.
when it was shipped.
Yeah, Sandy uses the accrual method. He records the sale in a month in which the product is shipped. It's kind of like when I send the invoice to Pete. So I'm not, because I'm doing a service. But he's charging when the product actually leaves him. So it's with the carriers that he said, okay, I'm going to charge you then.
So wouldn't it be when the order was placed?
When the order was, it could be the same thing too. It could be charged when the order is placed. It's now you're thinking practical. So let's just say yes.
You can count that income because the order was placed, so he counts that income then, even though he didn't actually bill for it until it was shipped.
Yeah, so there's a little rule of thumb, as in that this is a more complex one because inventory. There's a rule of saying that the inventory is still yours until it leaves the shipping, until it gets to the shipping. Now there's a different rules in that, but I'll go into details. But he gives it to UPS and is insured, whatever. Once it hits that dock, it doesn't belong to him. So that's when he charges them. So that's why I did the example like that. So the question is, should he be using accrual or should he be using cash? Is your cash basis? Is he right in using accrual?
Yes.
Isn't he required to if he has inventory?
Yes, he is. So yes, so you guys are correct. Sandy is correct in using accrual method. I think, yeah. So if you have any questions about the difference between cash and accrual, we could spend time on it more if you want, or we could, stay posted for the bonus seminar. Okay, so now we're going to go into more like I'm going to end with the business structure. So I'm not going to bore you and give you the definition of all. I'm really just gonna lay out what they are and kind of go into the advantages and disadvantages from a tax standpoint and maybe structuring standpoint. So I'm sure there's more out there. These are the basics. I'm not gonna go crazy. So the sole proprietorship, simplest, doesn't cost a thing. A lot of people, I was surprised just only this week that a lot of people, they set up an LLC. And in essence, what you're really doing is just setting up your sole proprietorship and letting the IRS, letting the state know that you have that and you have an EIN. And then, you know, there's a difference between that. If you're a one-person LLC, is that you have now a little coverage on liability. So that's the only difference here. I'll go into the LLC later, but this is the easiest. You're not filing a separate return. You're filing a schedule Schedule C that goes with your regular 1040, and that's the easiest thing here. The advantage. I don't know why I put Schedule C as an advantage, but that's what it is. The disadvantage is that once you cease to exist, the business ceases to exist, it doesn't continue, you are in fact the business, there's liability there, you could easily be sued. So if you're just doing knitting stuff, I feel like that's probably good, but if you're doing a sole proprietorship and you're doing people's books and stuff, you may not want to keep it a sole proprietorship. And I put this a disadvantage. It's you're subject to self-employment tax. A lot of people forget that too. So there's a self-employment piece. And one thing that I had a grandmother I did her return for, and she babysits, and that's self-employment, and it wasn't that much. So I had to tell her she has to pay taxes on that. People aren't aware of there's that self-employment piece that you have to pay. So that could be a little tricky if you're not thinking of how you're structuring stuff. And I'll tell you which ones are subject to self-employment as I go on. So the partnership, which is how I'm structured. So it has to be 2 or more people. Is easy to organize. It doesn't pay taxes at the partnership level, but everything flows through and down to the partners. There's 2 partners with us, so whatever the entity make, percentage of that comes to me and percentage that goes to someone else. So that's just as simple as it goes. When it comes to stuff like that, tax planning I think is critical, because you want to plan once the income comes to you, because obviously this may not be the only thing that's going on. Maybe the second partner has a job, maybe they have other property, maybe they're expecting losses from another entity, and there's limitations with losses and stuff like that. So you have to think about how you're going to structure this and how it's going to mean to you when it comes tax time as an individual, because businesses are great, but then it comes down to someone eventually. Again, the disadvantage here, the liability. Now, this is just, no one really forms a partnership like this, a general partnership, but they do exist. But, there's a liability issue if you don't form it as a limited liability partnership. If you form as a general, there's going to be some type of liability. And usually a limited partnership needs to have a general partner, and that person kind of takes the fall for everything if anything happens. And it's subject to self-employment tax if you are actively running a business. Any questions? Okay. Now it comes down to my LLC. Now, so it's a limited liability company, but it takes the structure of a partnership by default if it's more than one person. If it's one person, it takes this tax as a sole proprietorship. So the same thing, if you are individual, you decided to open up a LLC, you just kind of alleviate yourself a little bit of liability issues. It's still a pass-through, and it'll just be a Schedule C as it would have been as a regular sole proprietorship. That's just what it is. It's disregarded for tax purposes for the IRS. Different states treats LLCs different. Definitely there isn't a tax per se, but the state of New York charges a fee. It's a low minimum fee. Basically it's just kind of a tax, but they disguise it as a fee. So most states do charge fees. And again, it is, self-employment is there. You know, I'm not too sure, Pete corrected, I'm not too sure there's a law that says you can't pay yourself, payroll, but, you know, to do it that way is kind of silly, I think. Have you ever seen anyone get, like, stopped?
I know what the theory is and what happens in real life. I mean,
Yeah.
I think what you're supposed to do as an LLC is pay, it's called a partner guarantee payment, which is subject to self-employment tax. So you
Right.
don't get it withheld out of your check you receive every month. But I see people pay themselves W-2 all the time. I've never
Yeah.
seen anyone get it.
I don't think it's a law per se,
Yeah.
but I feel it's just one of those things that, you know, is what is right in practice. You know, they're all big accounting firms like PwC and all of them. They get W-2s and they get K-1s as well.
Right.
So it could be a mixture. If they are doing it, I'm quite sure it's not
It's
a law
like an
out there.
unenforced thing. If
Yeah.
there is a law.
Yeah, so I'm in a lot of chat rooms and stuff on Facebook and groups like that, and there people are really upset if they ask a question if they should be their W-2, and there's like, no, there's no way you can do it. And I'm sitting there like, I mean, why not? Like, okay, but that's the rule. You should be it is subject to self-employment tax. But I'm pretty sure if you only do the W-2 and don't pay self-employment and you're active, I think it definitely might raise a red flag. So that could be it. S Corp. This is my personal favorite entity. Things have changed slightly. I'm constantly trying to read up on stuff. I'm actually going to a seminar to make sure I have all the tools that I need to know to make sure that what's changed about S Corp that I know. But basically what this is, someone either formed an LLC or they form a regular corporation, and then they say, you know what, I'm going to make an S election. I'm a small, the S stands for small. So I'm a small corporation, and I filed this form 2553, and I elected to be treated as a flow-through entity. So what this is kind of the best of both worlds in a sense. There are some restrictions, you know, in terms of how many shareholders you could have. None could be foreign and stuff like that. But the advantages are you're taxed by default as a partnership. So if you could elect to be taxed as a regular corporation, but then why would you bother to do that? But so your tax as a partnership it has a flow through benefit. It flows to the all the shareholders. It could be one shareholder. In this case, you definitely should do. This is where I'm very advocate for this. It definitely should be payroll. So this kind of takes care of self-employment. You're not subject to self-employment through the business at this point. So in order to pay yourself, you should be putting yourself on payroll at this point. There's no guaranteed payments as it would be in partnerships, so you definitely have to find some way to pay yourself, and payroll is the best way to go by doing that. The disadvantages of the shareholders provide services considered employees. Yeah, so there's a compensation stuff. So it's I don't see much as a disadvantage. Is more that now you have to pay that tax, but you kind of sort of was paying it already if you had another structure with a self-employment. But at least at this point, a lot of people feel like they could just. I have had people just take money out. They just say, hey, I'm just going to pay myself and not do taxes. They've done that. We haven't gotten any notice. But I always advocate, hey, just put yourself on payroll and just, you never know. There were two girls in the bra industry. They decided to design better bras for women. And they started as an LLC. The minute an investor was, they knew they was going to raise funds. The investor asked them to change their corporation. You know, so investors who actually want to give money, they want equity. And there's no equity in an LLC, technically a partnership, so you're giving someone interest. So it's kind of, it looks better because what happens is now if your plans are to move on and go public or sell, it's easier in the structure of a corporation. And again, it's always good to sit down with an attorney. I find, like I help people in corporate business too, but I don't touch corporations because if it's a single person and I know you, maybe. But once it's more than one shareholders, I send you straight to a lawyer. I'm not touching it because then you have to have agreements amongst yourself, and all that stuff. And I feel that this is more of a legal aspect that's more than it is accountant. It's good to have an accountant on board or having a lawyer who has a little bit of accounting background, because you want to have these two people talking to each other, because you want to know. First, you want to know why you even go into business. That will take the president as to how you structure. And then the lawyer is always there to give you, the accountant is always there to give you the accounting and the tax implications of it. But most of the times you might get like a tax attorney, someone that has a background, and that works fine. So it's always good to have those two people.
Jesse, could you talk a little bit about the new, I think it's 21% corporate rate, and what
Yeah.
type of businesses that qualify and what don't?
So I've read up very briefly on it, and I haven't, see, the next series is gonna dive
Okay.
more into that, because
Yeah.
it's new. And I just started reading for next month, but definitely we're gonna hit into that.
Okay.
But again, that's why I was saying it's good to speak to lawyers and accountants, because new stuff is popping up, and you missed it. Earlier today I was saying I'm going to a conference this year to catch up on all the latest stuff and get ready, because it's like stuff comes out, it's not really, you don't know if it's law yet, and then boom, it's law. And that happens with our tax laws that change. There's all talk and smoke about it, and I was sitting in my office, and I'm like, I'm not even gonna dive into anything until he signs, and then I'm going to go crazy. But even then, things are changing, explanations are coming out, and what you thought was this is that. So definitely, what you're talking about, we definitely want to dive into that next time, because the structuring more is, I'm going to lead into structuring more next session. So, like, going back to the slide, the subject, the disadvantages. The tax is a disadvantage for the corporation, for the Swan Corporation. So you are taxed at the entity level, and once you take money out, dividends, whether you take out dividends or you take it out in payroll, it's going to get taxed again. So that's the disadvantage. So I feel that if you're just going into business because you don't plan on seeing this go to generations and generations, then keep it as an LLC. If you feel that you really have this good product, like these women with the bras, and then you feel like it's really going to go somewhere, then I say corporation. Don't not form a corporation because of the double tax. Like, that shouldn't be your end all be all. And again, like I said, always consult with an attorney and an accountant. I say if you have to pick between the two, I say pick an attorney. I'm not saying that because Pete is there, but attorney that's good with business, because not because someone has 3 letters doesn't mean, because accounting is very broad. They could be a forensic accounting. They don't probably know nothing about tax, so it varies, just like attorneys. But attorneys, they tell you what they're in practice for. CPAs, I feel like there's no way of knowing from just saying, the 3 letters. You don't know exactly what I do. So they just always assume that it's tax sometimes.
Yeah, I always think difference.
Yeah.
There's a major reason from a liability perspective of why you want to go.
Yeah.
one way or the other.
When I meet with a client, I always ask them, why did you structure it this way? Because I don't want to step on someone's toes and be like da 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 da. So if I had someone saying, hey, I think I need to do some planning, whatever, maybe restructuring because I'm paying way too much in taxes, and right off the back I could see that the easiest thing to do is change them to an S corp back a year ago, last year. So, but that is the first thing that comes to mind. But like I said, I'm an advocate for tax planning. Like, really get everything, get your last year financials, look at what you expect to do this year, and really map it down, not just at federal and then at the state. It takes some time. It is a little costly. It can be, but sometimes I do favors. Like, if Pete sends someone and say, hey, just do a rough something, whatever, and I most likely will never do rough because they're relying on these numbers. But those fees cost about, I would say, if I do tax planning for a high net worth individual, would be like starting at $2,000. But that's if I could save them about $8,000 by just restructuring stuff or taking advantage of certain deductions and stuff like that. Some people buy, they might buy 5 computers and they just never do depreciation. Like, I mean, why not? I mean, yeah, like computers are cheap now, so people think why bother, but when you buy 5, it's a significant cost in my mind, so. So that's it, I think, yeah, that's it. So it's short and sweet. I just wanted, we're gonna go really deep in the next time. This is just really just an intro, what to expect. I'm going to always post up what the lectures are, so if I don't see you next time, I won't be disappointed, but,
How
you
many
know,
are you doing?
for the rest of the year, I already have everything structured up until December. And I'm gonna keep going until no one shows up. Yeah, and definitely feel free to give me feedback if you want. If you say, hey, could you dive in more than this? If you just want to come, I'm on the 12th floor. If you just want to come up, you know, you could, you know, call me, whatever, and say, hey, could we do like a chat or something, or could you present on this? And I'll be happy to do so. If the demand gets up, you know, I might just do it more frequently. So, you know, and it pushes me to be more on top of my game and research, because I am aware of things, and until I actually need to do it, I don't really research it crazy, because I really go in. There's so many things you could do, and you just gotta save your time. So, thanks for coming, guys.
Thank you.
Yeah,